All right, we are now live. Happy Saturday, ChooseFI community. It's Jennifer Ma, your community manager, and guess who we have with Brad and me today? It's JL Collins.
The one, the only.
The man, the myth, the legend, the man who's post Why You Need FU Money, I Overshared, and the stock series. So I'm so excited. But before we start, JL, we have to ask Brad this pivotal question. Brad, how you doing, buddy?
The obligatory question at this point. It doesn't feel pivotal quite as much as obligatory, but I am doing quite well. It's a beautiful, beautiful day here in Richmond, Virginia. I already had a soccer practice that I coached for my daughter Molly this morning, and I'm here with you, and I'm here with my longtime great friend JL Collins. So it's hard to beat that.
So now that know that, it's a wrap.
That's all she wrote.
It was good talking to you.
Oh my gosh, thank you so much for making time, JL. It's so nice to meet you virtually.
It's a pleasure to be invited.
Oh my gosh, your book, your blog, that was the kicker. I think I found you first before I found Mr. Money Mustache or Mad Scientist, and it was sort of interesting to read your stuff, and I sent that around to everyone I know. Sorry to be a fangirl. You probably get that all the time, so I'll just dial that back.
Well, he does get it all the time, but I'm sure he doesn't mind, and I'll pile on here too.
Please.
And JL, I've told you this in person, but reading your stock series quite literally changed my life. I mean, there is no simpler way to put it than that. That was the first time that I had any clarity or understanding or faith in myself, frankly, when it came to investing. And all the good things that have happened since, I can really, to a large degree, and it comes from reading those posts. So, I mean, you have created a huge impact on the world just by writing into your computer. And, a sincere thank you from me and from all the tens of, obviously hundreds upon hundreds of thousands of people that have been millions. Yeah, that's not a stretch. So thank you.
And there was actually a really, I don't know, there was
Let
something
the man
really
respond, Jen. Let the
about
man
your.
respond.
Sorry.
No, go ahead.
We're
Jen.
a little excited if you couldn't.
I'm not sure how I can possibly respond to that. There's so much kindness in there, and I guess I would say I owe it all to my daughter. She's the one I started writing this for. As she's pointed out to me, if she had listened to me when she was young, I never would have had to write a blog or a book. And so mission accomplished. I've managed to convince her, but I stand in amazement and awe that it's affected other people in the way that you describe, and I do hear that on a regular basis. And
Yeah.
And it's a little overwhelming and very humbling to hear it. I don't ever quite know how to respond, but I'm delighted that it's had that positive effect for those who've had it.
Yeah, I actually had the honor of chatting with your daughter on the phone for a little while. And I did say, not to be a fangirl, I said, but your dad, I just wanted to let you know, you were the reason why your dad wrote that whole series. And I thank you very much for not being interested.
What did she say?
She laughed and she said, "You're not the only one who's told me that." And I just thought that was funny. That is absolutely funny. Oh, it looks like everyone's logging in from all over the country, and some people have stayed up late. It looks like this is so cool. One of the things that I thought was so interesting. One, I want you to know that your voice, whether it's spoken or written, is incredibly comforting. There's something with certainty that you write that simplifies complex matters into a distillable, relatable factor. You simplify language and an approach. So thank you very much. And for MK, would you please recite the alphabet?
MK would recite the alphabet?
No, it's a joke because on Friday she announced that you were coming on. She's like, I can listen to him talk, but he could recite the alphabet.
She probably just doesn't believe that I can recite the alphabet. I know it begins with A and it ends with Z.
But the best letters. Anyway.
Yeah. We have people, definitely. It looks like we have dozens upon dozens of comments already coming in. Definitely let us know where you're tuning in from today. It looks like, I was just going to say, I saw Scott Rickens.
Scott Rickens is in the house.
Hey, buddy, good you're here.
Seattle's represented. Yeah.
Oh, yeah. I'm seeing some familiar
Bob
names
from Surf City. I'm sure a bunch of people from Chautauqua are here.
Yeah. Oh, look at this. And Oh my goodness. The comments are coming in faster than I can keep
Yeah.
up with. Oh, Mark Troutman writes, JL, my daughter, age 20, just finished your book and had a question I couldn't answer. In the chapter, My Path for My Kid, you mentioned waiting until FluffyFi in your 30s before having children. Oh, fully. Sorry. I'm blind.
We've coined a new phrase, fluffy
I was
thigh.
going to ask, what is fluffy thigh?
Well, fluffy thigh is me.
That's a great name.
Round as a shape. I'm round, and I think of fluffy and voluptuous thigh. So that's me, guys. A fluffy thigh in your 20s before you're buying a house. And the comment went off screen, so I can't show the whole thing. Instead of being while on the path of gathering wealth, I'm going to assume. And there's so many questions and comments. Yeah, they're coming in so fast. I can't.
Yeah, when you go back and find that, Jen. But
yes,
JL, why don't we for the people who are tuning in who have maybe been living under a rock, they've never heard of you before. Give us a quick sense of maybe your high level. What is the simple path to wealth?
Well, so in the most fundamental way, the simple path to wealth is avoid debt. Save a portion of everything you earn. I recommend 50%. A lot of people in the FI community think that's way too modest and shoot for 60, 70, 80+%. Of course, a lot of people in the FI community think 50% is insane, but if you want, it depends on how badly you want to be FI. And then that's the capital you use to invest. And I recommend investing in low-cost index funds, and very specifically, I was once asked why my advice is so specific. It's because it is for one person, my daughter. I have her investing in VTSAX, which is Vanguard's total stock market index fund. And then once time comes and she's living on the portfolio, I recommend that she add VBTLX, which is Vanguard's total bond market index fund. So that's it in a nutshell.
Nice. And it is important, and yeah, that's wonderful. And we certainly, go more in depth, obviously, as the questions come in. And Jen, I'd love for you to pop in with your disclaimer here in a moment.
Of course.
It's important to note that, like you said, this was advice for your daughter, right? And that is why you were so specific. It's important, like we always talk about at ChooseFI, it's essential to get people to take action, right? For themselves, right? They need to take action. And in this case, if you said, oh, you should invest in low-cost index funds, I suspect there would have been friction there, right? Even more friction. I'm not sure that she necessarily jumped and followed your advice that second, but anything you can do to cut the friction. So I think it's important that, I, from ChooseFI perspective, say low-cost index funds are what we believe in. Now, because I personally have followed you for so many years, I personally invest in VTSAX, but there are many companies and many similar funds. So we do get that question a lot. And why are we in the bag for Vanguard, et cetera? And I mean, frankly, my answer is because I've read the stock series. So that's my own personal answer, but everybody has to do their own research and their own investing. And Jen, if you don't mind, if you could do your wonderful job with the disclaimer.
Just a reminder, everyone, this is just an educational and entertaining discussion. It is not meant to be or be construed as financial investment advice or financial advice for you at all. Please consult with your financial planner, your professionals, your CPA, your tax advisor, someone who knows everything about your life and can give you tailored information. So Facebook is not cooperating, so I can't find the rest of Mark's comment. So Mark, if you want to message me, I'll keep an eye out on Messenger for the rest of the question, but I thought that was sort of interesting.
Yeah, they
fully
are coming
in. So they're just coming in really fast.
Yeah, but so before we move on, let me respond to your comment there, Brad, and mostly agree with you. Now, when it comes to Vanguard, I specifically recommend Vanguard because there are things about Vanguard that make it distinctive, and in being distinctive better than, in my opinion, any other investment company out there. And if you like, we can go down that rabbit hole. But having said that, I agree with you. The beauty of index funds is an index fund is an index fund. So I prefer Vanguard, so I prefer Vanguard's total stock market index fund, VTSAX. But a total stock market index fund from another provider, be it Fidelity or T. Rowe Price or whomever, that's also a total stock market index fund, holds essentially the same portfolio, will get essentially the same performance, assuming that the cost is roughly the same, and all of those companies are competitive, as far as I know, are competitive with their costs. So I agree with you on that score. The other question along that same line I frequently get is, and it usually comes from people who look at their 401ks or 403bs and they don't see a total stock market index fund available, but they do see an S&P 500 index fund. And sometimes the comments are a little panicked and saying, what do I do? You know, all I have is this. And well, the Index 500 fund is a wonderful fund. In fact, it was the very first one Jack Bogle created. It was the one that he personally held to the time of his death. Jack Bogle, of course, being the founder of Vanguard and the one who created the very first index fund for us. So the S&P 500 fund is a fine, wonderful fund. Warren Buffett talks about Vanguard's Index 500 fund as the one he's recommending for his heirs. I prefer, and essentially these two funds, the total VTSAX, and I don't know the
symbol for
symbol.
S&P.
Thank you. I don't know the symbol for the S&P 500 fund, but they are very, very close. I think VTSAX is about 80% of it is the S&P 500. I like it a little better because when you own it, you own a little bit of mid cap and small cap. But if your 401k or your own preference is the Index 500, it'll serve you well for the decades.
Yeah. Okay, so I have Mark's question teed up down. Sorry about that. He did message me, so I'm very grateful he did that. And here is the question in its entirety. Okay, JL, my daughter, age 20, just finished her book and had a question I couldn't answer. In the chapter, My Path for My Kid, you mentioned waiting until fully FI in your 30s before having children or buying a house instead of while on the path to FI. Do I really have to wait until then? Would you discuss the reasoning behind that statement?
So, first of all, nobody has to do anything. This is just my recommendation. Let's be clear about it. And I believe in doing things from positions of strength. So too often, from what I observe, people have children from a position of weakness. They're not quite ready financially to have children. Now, frequently that works out, but there's a lot more risk in doing things from weakness. Frequently, people buy houses from a position of weakness. They're stretching in order to afford the down payment and the mortgage payments. Now, frequently that works out, but you give yourself additional risk. So what I'm really saying in that comment, waiting till you're FI or very close to it, or at least well on the path, puts you in a position of strength, whether you're choosing to have children or buy a house or a car or take a trip or anything else, or quit your job to pursue other opportunities. The whole idea behind pursuing financial independence, it seems to me, is to increase your freedom, and each step you take is a step closer, makes you that much stronger and allows you to make decisions from a position of strength. And I think that when you do that, you have take on much less risk. If you make major life decisions from a position of weakness, you leave yourself open to potentially bad outcomes. Does that make sense?
Yeah. Yes. I think that makes incredibly great sense, to negotiate and give yourself options and opportunities. And I'm going to piggyback on that question real quick. I was flabbergasted and riveted when you said you bought a house. I don't know. Could you please tell our viewers why I was so surprised?
Well, I'm not sure, Jen, I can read your mind. I am aware that I have a reputation of being anti-house, and it comes from a post I did a few years back called "Why Your House is a Terrible Investment." Go figure, how could that give anybody the idea I was anti-house?
I almost sold my house because of that post.
Well, I don't know whether you should sell your house or not. That would take a deeper dive into your situation. But I'm not anti-house, and to be clear, most of my adult life I've owned houses and lived in them. What I'm opposed to is the propaganda that's put out by the real estate industry and the mortgage industry, and there are a lot of industries that are satellites of those that make enormous amounts of money when you buy a house. So the propaganda is that it is always a good investment. It is a smart financial move. And it's not. It just isn't. Sometimes people get lucky and they buy in a rising market. Sometimes they get unlucky and they buy in Detroit a decade or two ago and get crushed. A house is a lifestyle choice. And if you can easily afford it, again, going back to our early conversation, if you can buy your house from a position of strength, which is how I bought all the houses I've ever bought, and it suits the lifestyle that you want and you can easily afford it, then by all means, buy a house. I recommend buying not the most house you can afford, but the least house that meets your needs. And that's candidly what I've already done. And to be perfectly clear, at the moment, I don't own a house. I don't have a permanent residence. I do own a cottage on the beach, which is where I'm broadcasting from. And it's sometimes I'm in residence here. Sometimes it's VRBO'd. A lot of times in the winter, because it's on the shores of Lake Michigan, it's closed up entirely. But it's not a permanent residence. Our permanent residence is nomadic.
That's awesome.
Yeah.
That is so awesome. But I had to just tease you a little bit about that one because of the house question.
That's fine. But it's an important point of clarification. I mean,
Yes.
when my daughter was in school, we owned a house because that was the lifestyle we wanted while she was in school. And we specifically bought it in a certain school district for obvious reasons. Mm-hmm. And when she went off to college, I couldn't wait to get rid of it.
All right, we have a ton of questions coming in here, and I think at this point, Jen and I are going to have to kind of just summarize them in rough order. So I've got a couple, but let's start first off with, okay, obviously since the beginning of March, JL, it seems, obviously the world has intervened and the markets have been crazy, and a lot of people are fearful. They don't know if they should be changing things. They don't know what they frankly don't know. They're fearful, and they would look to you to just hear what's on your mind. Like since February, since March, how have you been thinking through this? Has anything changed? Have you made any moves? Have you made any adjustments? Just talk us through what your mindset has been like for the last 3.5, 4 months.
Well, I've made a couple of minor moves that the market created opportunities for that we can get into, but they're minor in that it's nothing that changes the basic philosophy. So right now, well, of course, now the market's bounced back pretty strongly, but for a time there, we were in the process of a market crash, and that's a normal thing. I mean, market crashes happen on a fairly regular basis. Fortunately, not very often, but we get 10% corrections on a regular basis. We get 20% bear markets on a little less, but still regular basis. And every now and again, like we did a couple months ago now, we get a crash. That is a normal part of the stock market. Now, the only thing that was not normal is what triggers the crash. And every time it's something different. I kind of knew something was coming simply because it had been a long time. I never would have predicted or tried to predict when it was coming, and I certainly wouldn't have tried to predict what would trigger it. I think it's tragic that what's triggering it is costing lives with the COVID virus, but something always comes along, and then the market recovers and goes on to new heights. So from that point of view, from the market point of view, nothing has changed. In the midst of the plunge, I was writing much more frequently than I usually do because of this topic. And there were a lot of comments on my Twitter feed and on my blog posts from people who are saying, well, this time it's different. And of course, that's what everybody says with every market crash is this time it's different. And I sort of tongue in cheek put a tweet up at the time saying, I've discovered a new symptom of COVID-19. Clairvoyance, because everybody seemed to know what the market was going to do, which of course was to continue to plunge. And as we know now, the market did the very opposite. Some wag once said, the market will always do whatever it takes to embarrass the most people.
I might have to quote you on that one. But yeah, Brad
Well,
summarized that question right. Like, why would what were your philosophy? Because everyone's wondering, should we stay in VTSAX? Should we move to something else? And then um, one.
my philosophy, Jen, in a nutshell, is nobody can time the market. Nobody can predict when these things are going to stop or when they're going to turn around, when they're going to get better. So the time to invest is when you have money to invest. If you happen to be lucky enough to invest when the market's crashing, then that's a blessing. I mean, I tell especially young people, like, there's nothing more favorable to you than a nice solid market crash that brings prices down. When my daughter puts in money every month, like clockwork, which is what you should do. And she
Mhm.
saves 50% of her income, as I recommend. And I noticed in April, I think it was, that set amount of money in April bought 19% more shares of VTSAX than in March. That's a blessing. So instead of being scared by market drops, you should welcome them. You should take advantage of them. You should certainly keep investing during them because the market will always turn around and it'll always go back up. Now, if you happen to be retired and living on your portfolio, then at that point you have bonds in your portfolio, and the bonds are what you use to smooth the ride. But for people like my daughter who are still working and investing, this drop has been a bonus.
Yeah.
So you said in there something to the effect of the best time to invest is when you have the money to invest, right? And we've actually had a bunch of questions just in the first 15, 20 minutes here about dollar cost averaging versus lump sum investing. And
Mhm.
I think there might be a mathematical answer and there might be a whatever lets you sleep well at night answer, but I'd be curious to hear your thoughts and how you advise people who are going at this for maybe the first time and they don't know what they should do.
Well, so you're right. There's a mathematical answer and there's a psychological answer, and I'm a little bit hard nosed on those two things, I should say up front, because if you're choosing between them, if you choose to do what's comfortable psychologically, you are just comforting yourself. You're not doing what's best from an investment point of view. So I very much defer to whatever the mathematical answer is. You should adjust in my world, you should adjust your psychology to the math, not the math to your psychology. So having said that, the market goes up 75% of the time and it goes down about 25% of the time. Another way to say that is it goes up 3 out of 4 years, goes down 1 year out of four. Of course, you can't predict. It doesn't do that on a regular basis. It doesn't march up reliably three and then drop one. But on average, that's what it does. So if you're sitting on a lump sum of money and you're deciding whether or not to invest it now or to dollar cost average it, what you're really betting on is the market going to go up from here or down from here?
Mhm.
And history tells us there is a 75% chance that it's going to go up. And it seems to me that is always the right bet to take. It's not always the bet that's going to turn out. 25% of the time it'll be the wrong bet, but you don't know what the future holds. And therefore, the logical mathematical thing to do is to invest now because you have a 75% chance of that winning. The other thing that I would point out to people is that let's suppose you decide to dollar cost average because you don't want to take that chance that it's going to go down. And that would be a scary, terrible thing. I get that psychology, but remember, I recommend we defer to the math. But let's suppose you're going to make yourself psychologically comfortable. You have $120,000 to invest. You decide to put it in at $10,000 a month over the next year. Well, if the market goes up, you'll lose money because every month you'll be spending more for those shares. You'll get fewer shares for your money. If the market's flat, you'll lose money because your money won't have been working for you as long. The only way you win is if the market goes down. Well, let's, for the sake of argument, assume that it's flat and you get invested and no harm done or no major harm done. And you put in that last $10,000 and you send in that check or it goes electronically. And the next day, the market drops 30%. So dollar cost averaging doesn't really protect you from the thing you're trying to protect yourself from. Another way to think about it, and one of my blog readers pointed this out in a comment, is if you have that $120,000 invested, however you got it invested, every day you're essentially saying, I'm going to choose to keep it invested rather than pull it out and begin to dollar cost average it back again. Now, to be clear, we are talking about investing a lump sum. When you're like my daughter and you're investing on a regular monthly basis from your income, from your cash flow, from your job income, that's dollar cost averaging in a sense, but it's unavoidable. That's the only way that you can do it. And if you set it up and automate it, then the fluctuations in the market work in your favor. But investing in a lump sum doesn't work in your favor unless you happen to get lucky enough to invest at the beginning of a drop. And you've got a 25% chance of winning that bet. So
JL. Oh, I'm sorry. So in terms of that, may I ask you, because the way I keep myself invested and keep continuing to invest is looking at my investment policy statement or my investment philosophy statement. Would you mind sharing yours do you have one? Do you use that? Because I look at DCA as a tool that helps me stay on track for that.
Right. I don't have an investment statement. I've heard of them, and I suspect it's probably a good idea. Again, things are pretty simple in my life. I want my money working as hard as possible all the time. So I want it, in as much of it as possible, invested as often as possible. So I guess that would be my investment philosophy or statement.
Yeah, and I like the phrase that you used before about it being the right bet. And it's interesting because Tommy actually put a comment in here. I know Tommy's a poker player. He said lump sum is pocket aces, dollar cost averaging, pocket twos. 80% of the time aces wins. Which hand do you want? And I would extend that to say, if you were to play that hand 20,000 times, you would pick aces 20,000 out of 20,000 because you're going over the long run, you're going to win. To your point, there are going to be instances, and I guess you're saying 1 out of 4 years is down, but there are going to be anecdotal instances of it going down clearly, but the right decision over the long run, in your estimation here, is the lump sum investing. And that's what the math says, right?
Well, I was going to say, it's not in my estimation.
Right. No, I know.
That's what the math says. That's not just JL Collins giving an opinion. Of course. Right. And now, having said that, let me sort of argue against myself and go to the psychological side. So I said at the beginning that I believe you should adjust your psychology to the math, not the other way around. But the question legitimately can come up is, well, what if I can't do that? I mean, what if the idea of putting my lump sum in today and the possibility of there being a market crash tomorrow is just more than I can psychologically bear? Well, if dollar cost averaging is the only way for you to comfortably get in the market and you want to be in the market, then by all means, dollar cost average into the market. Understand that you're not doing the mathematically optimal thing, but at least you're getting yourself invested. Now, I have to add a caveat to that real quick, that the only way you should ever invest in stocks, following my advice or anybody else saying to invest in stocks, is if you know you are not going to panic and sell when the market plunges. Because if you do, then following my advice will leave you bleeding by the side of the road. It is very much contingent on staying the course. You need to strap yourself to the mast, as who was it? Ulysses, I think, was the one who strapped himself to the mast to keep from being drawn on the rocks by the sirens. And of course, the sirens are the news media going nuts, telling you this time is different and the end is here. So you got to strap yourself to the mast and stay the course.
I like that.
And if you don't think you're able to do that, then you don't want to be in stocks.
Yeah. I would be curious to ask about reassessing risk tolerance. So for someone who maybe they've been investing for the last 10 years, things have been going swimmingly well, and maybe mid-March into April was the first time that they've experienced that 20-30% drop, and maybe they didn't sell, right? Maybe they listened to you and they didn't panic sell and didn't lock in that scenario. But they're realizing hey, maybe I'm not cut out for this like I thought I was. What would you say to a person who came to you with that? If how would you, I guess, try to talk to them about long term, but also if they truly did realize something about themselves and they wanted to make moves, how would they even go about that?
Well, that's a great question. So if you're invested in stocks and you find yourself in a sudden plunging market, and it turns out that it is far more uncomfortable for you than you figured it would be, I guess my first piece of advice would be to stay the course till you get through this market cycle. And unless civilization ends, unless the US economy ends, unless publicly traded stocks go away, we will get through this cycle and go on to new highs. But you've learned something important about yourself. And by the way, there's nothing wrong with learning that psychologically you're not comfortable investing in stocks. That's a very important bit of self-knowledge. As the philosophers say, know thyself. There's a guest post on my blog from a couple of years ago written by a guy named Steve, and he doesn't invest in stocks. He invests solely in cash. He doesn't want to deal with volatility of stocks. And I absolutely respect that. And I put his investing approach up on my blog for that reason. You don't have to invest in stocks. I think it's the most powerful thing you can invest in, but it's certainly one of the most volatile. And if that volatility keeps you awake at night, and you can't adjust to it, then it's good that you know yourself, and there's no shame in that. And you probably ought to be looking at something else.
Yeah, and know thyself. It's important. And Allison, Jen popped this across the screen before. She said it's better to dollar cost average than to be paralyzed by fear and not invest at all. And I think no matter what our opinions are, again, knowing yourself is really important. And frankly, JL, dollar cost averaging is something that I do, and I know it's not optimal. I know it's not, but for my wife and I, it's just something that is easier psychologically for us. And I know it's suboptimal. And
for just a couple of moments ago, I said the very thing, that if you are psychologically uncomfortable investing the lump sum, understand that you are adapting the math to your psychology, and that's not optimal. But as your commenter, I forget her name,
Allison.
As Allison said, if it's that or not invest at all, then I agree with Allison.
Yep.
And if that's the way you're comfortable investing, Brad, then, and you're certainly, you know the math as well as I do, that's a choice that you make.
Yeah. Yeah. And there is an opportunity cost, unquestionably. And we've had a bunch of questions here. I suspect this will be a fairly quick answer, but about VTSEX versus the ETF version, which is VTI. Elizabeth said, I spoke to a Vanguard advisor yesterday, and he recommended the ETF version of VTSAX versus VTSAX itself. He said it has a lower fee. What are your thoughts generally on why you would recommend one or the other, or are they substantially similar in your opinion?
Yeah, so I have a post on this, and I'll let people go to the post for details, but they are, for all practical purposes, the same. I'm in VTSAX, I suppose, primarily because when I started investing in it, ETFs weren't around. But VTI holds precisely the same portfolio. It does have a slightly lower expense ratio. The difference in that isn't enough to make your choice for you. But yeah, just like buying a total stock market index fund from somebody other than Vanguard is fine, buying the VTF version is fine as well. You're buying essentially the same thing.
Well, may I add, as a layman without a blog, is that
that doesn't make you a layman.
Oh, okay. So I actually prefer the mutual fund because I don't like having money set on the side. And other than like having a robo-advisor like Betterment, my ability to fractionally purchase fractional shares of an ETF is minimal. You usually have to, through Vanguard, buy a whole share. And unless that's changed recently, that's one of the reasons why I've stuck with the mutual fund version, is that it allows me to get the money in the market faster. So, that's my reasoning versus setting it in the holding account until I had a full share's worth.
Yeah, that's one of the things I talk about in that post. But again, fractional, that's a fairly minor thing.
Hmm.
So
Yeah, I
you
think a
know,
share is under $100 of VTI or somewhere right in that vicinity. So,
yeah,
Yeah.
something
but
like
yeah,
that.
that's all cool.
So yeah, I mean, it's again, if you're comfortable with the mutual fund, then do the mutual fund. If you're
Yep.
comfortable with the ETF, then do the ETF. There are more important things to spend our time worrying
Yeah,
about.
agreed.
Actually, the other thing I noticed recently that also shocked me was that you were considering adding international funds to your portfolio. And I
Yeah.
don't, longtime readers like myself are probably going, whoa.
And
So,
Andy asked that question. I actually jotted it down. He said, yeah, when would you consider? It's a much longer question, but essentially, like, what would
mhm,
compel you to consider international funds?
yes,
So
I understand.
I think let's start with the fact that I've never been opposed to having international funds in the portfolio. I just don't see the need for it, and I still don't see the need for it. And again, I have a post on this that goes into some detail as to why that is. But to answer this question very specifically, I think about as to when I might change that, and I don't anticipate changing my portfolio anytime in the near future. To be clear, I probably don't have to in my lifetime, but I talked to my daughter about this because she might want to do it in her much longer lifetime. So think about it this way: we come out of World War II, and every industrialized country in the world, other than the United States, is literally in ashes. I mean, literally bombed into ashes. And so, not surprisingly, the world economy at the time is essentially the United States. The world economic pie is almost 100% the US. And then,
Mhm.
of course, the rest of the world begins to build. And two things happen as the rest of the world begins to build. And by the way, the United States played a key role in helping the rest of the world rebuild, is the pie itself begins to get bigger and bigger as those other economies get back on their feet. But by definition, as they get back on their feet and stronger, the share of the pie that the US represents begins to drop from close to 100%. And now, as we sit here today, it's somewhere around 50%. So, and I'm probably not exactly right about that, but it's about 50%. And with a little bit of limited analysis, you might look at that and say, wow, that's terrible. We've gone from almost 100 to 50%. But you have to understand that it is a far bigger pie. So this is not only good for the United States, it's good for the rest of the world who's growing and participating actively in the market. I see that continuing. I think the rest of the world, and of course, what we used to call third world countries, are beginning to blossom with their economies. So they'll be getting a bigger and bigger share of this pie, and in the process, making the pie itself bigger and bigger. And so the US will have a smaller percentage of it, and yet a bigger and bigger economy from it. So good for the US. But at some point, the US share will be too small to want to focus only on the US market. It's the same reason that I don't recommend any other residents of any other country buy only their own market. I certainly don't recommend Canadians buy only Canadian stocks. Their share of the pie is simply too small. The same thing with the UK, the same thing with Germany, the same thing with France, the same thing with Australia. Great economies, but the share of the pie is just too small and too limited. The US is the only economy that's large enough where you can get away with owning only the US economy. But the trend, assuming the world market, the world continues to grow and expand and get better and better as it has over the decades, our share is going to get smaller and smaller. And at some point, investors like my daughter are probably going to want to own the entire world. And in fact, when I'm talking to international audiences, if I were a resident of any other country, I'd probably already be owning the rest of the world. It's not a bad step to take now. I just don't think for those of us in the US, it's a necessary step yet.
Jim, so we're talking about international, and I've seen some questions come in about bonds as well. So Kevin said, what are your thoughts on VBTLX now, since everyone is saying bonds will not have the returns needed to keep up with inflation? So I guess you could answer Kevin's question specifically, or just kind of talk about the role of bonds in a portfolio or your portfolio, I guess.
Well, so first of all, let's I'm going to challenge the idea that it's not going to keep up with inflation. We don't know that. We don't know what interest rates are going to do in the future, and we don't know what inflation is going to be in the future. But having said that, bonds serve as ballast in my portfolio. So I don't hold bonds for their return. I'm retired, and my daughter doesn't hold bonds at all because she has the cash flow to invest and take advantage of market dips from her earned income. If you're living on your portfolio, you want bonds as ballast. So you have something else that smooths the ride of stocks. Your income flow for young people working smooths that ride. And in a portfolio where you're living on it, that's the purpose bonds serve. To put that in perspective, a few years ago, I was looking at higher return bonds, which of course have a higher risk. And I was fooling around with those a little bit. And I wrote a post about this back then as well. And I finally went back to VBTLX. There's a post about returning to VBTLX because it occurred to me that if I really want to seek better returns in my portfolio, then bonds themselves are the wrong choice. I ought to increase my allocation in stocks because stocks are a much more powerful driver of growth in a portfolio than bonds are in most economic environments. So bonds are not there in my portfolio for their return. They're there for ballast.
Yeah, I would agree with that. Sort of smooths out that ride.
Sorry, Jen. There's actually a follow-up almost perfectly. I'm sorry to talk over you, Jen, but Jim actually said, can you talk about the mechanics of your drawdown strategy?
Yes, I actually saw that question
perfect.
too. Yes.
If you want to put that up while I'm reading it.
Can you talk about the mechanics of your drawdown strategy during these uncertain times? That is, if you have cash in shares, do you cash in VBTLX during these times instead?
So drawdown, my situation is a little bit different because actually I do have cash flow now because the blog is making money in the way it wasn't when I was writing the book, and the book is paying royalties. But if you're drawing on a portfolio and you have a mix of VTSAX and VBTLX or something similar, VBTLX is paying, I think, around 3% interest, and VTSAX is paying a little less than 2%. So let's say you're averaging 2% on the portfolio, maybe a little more. Assuming you're using the 4% guideline as your target for withdrawing, well, the first thing you do is you tell Vanguard or whoever your investment company is that you want your dividends and interest paid into your checking account. And now you've covered 2+% of the 4% you're looking for. And the other 2% or slightly less, you raise by selling shares. And when the market is down and stocks are getting hammered, then you probably want to raise that selling some shares in your bond fund. When the market's rocking and rolling and increasing, then you probably want to sell shares in your VTSAX to raise that 2%. But that's an important thing, by the way, in terms of when people panic and the market's plunging, somehow they get themselves psychologically thinking that, the market's gone down 30%. I've lost 30% because I'm living on my portfolio. Well, no, you're only at the most drawing 2% from your portfolio if you're living on the recommended 4%. Does that make sense?
Yeah, it does make sense to me. And actually, we had a question. I was scrolling up here to try to find it. It was Sirusum, I believe, is any thought on dividend stock investment? And since we're talking about selling shares and living off things, this was an interesting question. I just knowing you as I do, maybe I'm going to buckle my seatbelt here.
I'm right along with you, man.
Well, teed it up for you, JL. Teed it up for you. No, it's a legitimate question.
Just kidding.
A lot of people do have this question now.
Yes.
Yeah, so I'm not a fan of dividend investing. I have a post on this that goes into it in some detail. The problem I have with dividend investing is that dividends are not magic. So dividends are one way. When you own a company, when you own a piece of a company, that company can and should return value to you. And there's a number of ways it could do that. Paying dividends is one of those ways. And typically the companies that pay dividends tend to be older, more established companies that have high cash flow and relatively low growth prospects. Companies that are younger or just more growth oriented tend to take that capital, those profits, and reinvest in their own business. And that's another way of returning value. I don't mind owning dividend companies. As I mentioned, VTSAX throws off about a 2% dividend, and that comes from the stocks in the index that pays dividends. And that's useful when you're withdrawing. But I also want to own everything. I want to own the companies that are on a faster growth trajectory. I don't want to own one class of company. And I guess that's the main problem I have with dividend investing is basically you're saying you're owning one kind of company, which tends to be old line, large, established, dividend paying companies. And I wouldn't want to own any one category of the market. I want to own the total stock market. Right. And again, we can spend a lot of time in this rabbit hole if you'd like, but I do have a post going into detail for those who care. Awesome. And I have a very good search function on my blog, so just type in dividend investing and you'll find it.
And William just followed up saying, important to remember that dividends aren't guaranteed. In recessions, dividends do get cut, and you really shouldn't count on being able to get 2 to 3% returns out of your portfolio without liquidations. So that's added on top of your point, obviously.
Yes.
Yeah. Go ahead.
And Jen, you were going to ask your question. I talked over you. I'm sorry.
It's okay. I agree with William completely. It's one of the reasons why I'm not focused on dividend investments. It's just a bonus if I get them because I can't control those. But we've actually had several questions that have popped up also asking about your rebalancing philosophy or what your process is. How frequently do you rebalance? And are you rebalancing across all your holdings, both your taxable and your retirement assets?
So that's a great question. Let me start with the observation that Jack Bogle, again, Jack Bogle being the founder of Vanguard and the guy who created index funds for us, never rebalanced his portfolio. He just didn't bother. Now I do rebalance, so that, and I have the highest regard for Jack Bogle. So the point I make there is rebalancing is not something that I obsess over. I don't think anybody should obsess over it. If you're going to do it, and I do it, you want to look at your whole portfolio as one complete entity. So in my case, that means both what I hold and what my wife holds and what we hold together. So, and the only two funds we own are BTSAX and VBTLX. We own the bond fund in our IRAs because that's where it's most tax advantaged. So when I'm rebalancing, and I try to hold about 75% stocks and 75 to 80% stocks, and of course that means that 20 to 25% bonds. Again, I don't obsess about it, but when I adjust it, I just go in and either in my IRA or her IRA, or occasionally in both, if I'm in the mood to do that, I'll sell some bonds and buy more stocks when the market was low, and vice versa when the market's high. In terms of when I do it, we've decided that we're going to do it on Jane's birthday, which is in April. And we chose that because it is a random day as far as the market's concerned. Not a random day in our life, but as far as the market's concerned, it's a perfectly random day. I would not adjust portfolios at the very end of the year, the very beginning, because just too many people are doing that, and the market does silly things at that time of year by and large. But you can pick any random day, and I choose my wife's birthday, and then we'll adjust it. And frequently, it's not so much out of line that we have to bother. And the only other time I adjust it is if the market does something dramatic, and dramatic enough to really move the allocation I want out of whack, and then I will have noticed that, and I'll step in and adjust it then.
So that naturally begs the question. We had something fairly dramatic in the last 90 days. Did you personally make moves?
You know, the only move I made, and I wrote about this, and it confused a few people. But when the market dropped, you know, I have, as I mentioned, VTSAX in our taxable account. Jane and I have it in a joint account. And we had a fairly nice gain in it because, of course, the market had been going up. But when the market plunged, the value of those shares got down to where they were dead even with what we paid for them. And that meant that essentially I could lower my cost basis in those shares. So what I did is I sold my VTSAX in the taxable account, bought and put all that money into VBTLX in the taxable account. And I sold them basically at zero capital gain, zero capital loss. But now the basis was lower. And then in the IRA, I sold an equivalent amount of VBTLX, the bonds, and bought an equivalent amount of VTSAX. So when the dust settled, I had exactly the same allocation. I just had the bonds sitting in the taxable account, and I had lowered my cost basis on that stock. Now I just reversed that, I don't know, a week and a half ago maybe, because the market went back up. And so I sold the bonds in the taxable account and bought VTSAX again at a higher price, raises my cost basis. And then I turned around and sold an equivalent amount of VTSAX in the IRAs and bought the bonds. And so again, the allocation doesn't change at all. So when the dust settles, I have exactly the same allocation, exactly the same portfolio, but now the capital gain that had been in VTSAX in the taxable account is now gone. And I'm starting at a higher basis. I know that might sound a little bit complex, and I know that because it confused some of my commenters.
Capital gains harvesting, and basically, right?
Well, no, because I wasn't harvesting capital gains. I was just raising my cost basis.
Right. I mean, you're looking at your portfolio as a whole, and I think that's what you mentioned 15 minutes ago. Is how you conceptually approach your entire wealth, your net worth is as a whole. Right. And if it's advantageous in certain buckets or certain umbrellas, like an IRA or 401k or whatever it may be, then if you have a risk-free way to do it like this, where there's no taxable event, you took advantage of it.
Right. So if anybody who's listening is interested, I think back in April, I wrote the post to how taking advantage of Mr. Bear. That's a title similar to that. And then in my most recent post, which is how to give when you own a business, at the bottom of that post, I have a little report back of how I reversed this, as I just discussed.
Nice.
So anybody who's interested in that, what I actually did, wants a little more detail, it's in those two posts.
I really like Maria Hernandez's question. It'd be great to hear about what to hold in taxable accounts to lower volatility, considering that's what we will have available when we early retire. Any thoughts?
Well, first of all, what I hold in our taxable accounts, now that this little game I played is over, is VTSAX. And that, of course, is much more volatile than VBTLX. So I'm not sure I'm an advocate of holding things in a taxable account to avoid volatility. I'm in favor of holding things that are very volatile, namely stocks, because they give you the best return over time. I suppose if you wanted to hold something in your taxable account that was not volatile, you'd tilt towards bonds. But you're going to pay a tax penalty for that because, of course, they throw off a little more interest than VTSAX does. Again, this probably goes back to the point that Brad was making, that I advocate looking at your portfolio as a whole, not as taxable and tax advantaged. So I would still keep your volatile investments if you're looking for growth, but I wouldn't keep them in my taxable account.
And JL, talking about the different, we're talking about bonds
I misspoke. I'm sorry, Brad.
Okay. No, please.
I would keep them in my taxable account.
Okay.
No,
thank you for clarifying.
Yeah.
So my stumbling actually worked out well there. So Amanda asked a question about cash and about how many months she's talking about in COVID times, but I think just generally, let's make this broader. Do you keep a certain amount of money in cash for X number of months of living expenses? Do you subscribe to those type of theories? How would you talk through that?
So this is one of those things where I'm not opposed to it. I've never particularly kept large amounts of cash around because, again, the volatility doesn't concern me as much. I recognize that when the market, if I'm living off the portfolio and the market plunges, I'm going to get a little better than 2% of what I need just from dividends and interest, and the other 2% from selling shares. And if I have to sell those shares for a few years while they're down, that's just not that big a deal to me. So I've typically only kept as much cash on hand as I need to pay my routine bills. If somebody says, well, I want to keep more than that, I want to keep 3 months or 6 months or 3 years, and there are all kinds of things out there, that's fine. But again, you're serving your psychology rather than the math. The math would indicate that the market's much more likely to go up over any given period of time. But again, if it helps you sleep at night, then by all means, feel free to do it.
JL, we've actually had a couple questions along the same line, and this is kind of off the wall as compared to what we're talking about here. But let's say, so Avner asked, I understand your strategy to achieve long-term growth, but with all your funds in Vanguard, how do you protect yourself from the prospect of financial ruin? And now with the question that gave it more flavor above was talking about having all of your financial assets at one institution. And I think, the question was, what happens if Vanguard goes bust? And, I have seen that 2 or 3 times just in this feed already. So I guess let's take it more broadly. Are you comfortable holding all of your assets with one institution? And, is there ever an instance where you would kind of diversify just in case, who knows, you had an issue connecting your bank that day, or there was, a fraudulent login? Like, do you ever think through that?
Well, though, that's interesting. That fraudulent login kind of thing would probably be more of a concern than Vanguard going bust. I have in fact, one of my earliest posts in the stock series is what happens if Vanguard gets nuked. And there's really, in my view, nothing to worry about on that score. That falls under the category of we have more important things to worry about. It's kind of like the conversation about, do you do the ETF or do you do the fund? It's just not a concern for a variety of reasons that I'll let people read the post if they're interested in. The idea that something short-term, fraud might interfere is a more interesting one. But, again, I have all my money in Vanguard. I sleep well at night with it. Other than, I have a couple of bank accounts for different reasons, and I have cash in those to pay the routine bills. So I think there are more important things to worry about in life, I guess.
Fair enough.
Yes.
Cindy.
Well, I had some questions that were not about investing in this particular place in time. Like, I wanted to know what you thought the future of Chautauqua would be, because I desperately want to go to one. Do you think we'll be up and running in 2021?
So do we need to define for the audience what Chautauqua is?
Oh, yes.
Yeah,
I sort of assume that they're all fangirls like me, but yes, please do.
No one is a fangirl on your level, Jen. No.
Oh, please.
No, just kidding. I am. I'm a fangirl as well, believe me.
So Brad's been a speaker. I'll take a break and let him tell us what Chautauqua is, and then I'll answer your question, Jen.
Yeah, and I saw our good friend Raina in the stream here. I'm sure we have a bunch of Chautauquans, so maybe people can give their own flavor. But yeah, Chautauqua is an immersive, really, in my estimation, a life-changing event. I mean, we've kind of talked on the podcast certainly about some of these shorter events, the Camp Fives, even like the FinCons, and there is value to them certainly, but there's value in being around your community. There's value in being immersed, but But I have to say, going to Chautauqua is unlike any other event that I've been to. It's a week long. You make in-depth relationships, lifelong relationships. I flew up to New York a handful of months ago to see some of my friends, including Raina, and just hang out for the weekend. I mean, these are lifelong friends, and it's hard to describe how quickly you can get deep with people, right? And we're all there. We've flown halfway. In this case, we flew to Greece. We flew halfway across the world, and Jim and Alan and Katie Donegan and Jim's wife and daughter, just put on an incredible week. It was top class in every possible. Jim, I could go on and on here and give a commercial. I mean, but it's a remarkable event. There are speakers. There are, one-on-one events where you sit down and you really talk through things. So, truly life-changing. So, Jim, hopefully I did it some justice there. I don't know how.
I think you did a great justice. It was an idea I came up with.
Oh, Bill's here as well. Thanks.
Yeah,
Steve.
It was an idea I came up with in 2012. We did the first one in 2013. And the basic concept that I had was to go to some cool place, hang out with cool people, and talk about cool stuff. And as the founder of it, I got to decide the definition of cool in each of those cases. So it's been a great event over the last few years. COVID did it in for 2020, which is what Jen is referring to. We are planning to do it again in 2021. Of course, nobody quite knows what this virus is going to do in the next several months or years, but the plan is to bring it back in 2021. We are looking at Croatia as the location. Now that's dependent on finding the right venue at Croatia. And Alan and Katie are planning to do a scouting mission in Croatia sometime in the next few months and look at things, because we never go anywhere we don't actually lay eyes on and experience at least one member of our team ourselves. And the other interesting thing is that last time I was talking to Alan, which was a week and a half, 2 weeks ago, he came up with an idea that maybe we do something this year online for the people who are on our mailing list. And we have 4,000 people on the mailing list for Chautauqua at this point. And to put that a little bit in perspective, one of the things that makes Chautauqua magical is we limit the number of attendees. So it's as Brad said, it's a very intimate group. And the limit is 30 attendees. And we do maybe 2 a year. So we've done as many as 4 a year, but somewhere between 2 and 4 is what we do in a typical year. So, by definition, we're looking at maybe 120 slots. So we are thinking about maybe doing something virtual this year. And if you're on the mailing list, then you'll hear about it. And if you're interested in getting on the mailing list, FIChautauqua.com will get you to the website.
Yeah. For some reason, every time I share a link on our live stream, when it displays on screen, it actually truncates the .com, so it says .co, but it is .com. I put it in the live stream so you guys can go all visit it. I am hoping that you'll do something virtually, but I am excited to hear that Croatia might be on the list, because I've never been, and that would be so much fun.
Yeah, well, I've the same reason that I want to go. I've never been, and it's supposed to be super cool. So
yeah,
that's how we choose them, Jen.
Okay, great. What else is on your list? Have you been to San Diego? Now, I would not be doing a service for my community here if I didn't pitch that one. Come on. Brad knew that was coming.
I have been to San Diego, and it's a wonderful place. But
anytime you want to come to visit, you have a friend here.
Oh, I appreciate that. I'm always looking for people to impose on.
Of course, guest room, still ready.
Hey, Jim, we've been getting a bunch of questions kind of about the macroeconomic environment and, government debt and, is now a good time to invest long-term and volatility, all the normal things you would expect people to ask. And I'm curious if that's something you even want to touch, or do you concern yourself with the the 3, 6, 12, 24-month macro environment? Like, do you just kind of do your thing? Like, what are your thoughts, if any, on that?
So yeah, that's I tend not to like to touch on that, but I will, particularly on the debt part of it. My basic philosophy is that we live in a very resilient country, and capitalism is a very resilient system, and it's brought tremendous blessings to the world at large. And I anticipate that's going to continue. If that were to stop for some reason, then my approach is probably not going to work anymore. I mean, that means the end of our economic system, at least as we know it. And my approach only works if that economic system continues in the United States and in large parts of the rest of the world. I believe that that's the case, that it's going to happen. But if something major derails that, then my approach isn't going to work. But I can't think of any other approach that'll work better in that case. That'll be such a bad and chaotic situation. So you have to look at it and say, well, again, sort of like when we were talking about dollar cost averaging, what are the odds? Could a black swan event come along and derail it? Of course. I mean, anything's possible. By definition, black swan events are very rare. So you have to ask yourself, do I want to structure my investing portfolio, my investing approach, based on what is likely to happen 1% of the time, or what's likely to happen 99% of the time, which is kind of how I see it. Talking about the national debt in the US, and also, frankly, by extension, in the rest of the world, I'm frankly a little horrified by it. Before COVID started, we were, I think, at $24 trillion here in the US. COVID's added another 2-3 trillion to that. I've heard estimates that this year alone will add 10 trillion to it. That's one thing that frankly has me very, very nervous. We came out levels of debt, not dollars, but in terms of against GDP. The only time we've been close to this is when we first came out of World War II, and then we immediately began paying it down. When we came out of the 07, 08, 09 crash, that debacle, we drove up our national debt, getting out of that, which was probably the right thing to do. But then in the boom years afterwards, we just keep adding to that debt. And now here we've entered the next crisis, and we're accelerating that debt with no end in sight. What really disturbs me is there's not a single politician, with maybe on rare occasions Rand Paul, who even talks about this, who even considers it an issue on either side of the aisle. So it doesn't matter what your political persuasions are, nobody's looking at it. Now, there are some economists that say it doesn't matter, and I've read some of that stuff, and it's comforting to read, and I sure as hell hope they're right.
Yeah.
Okay.
And
so,
it looks like you're sorry, go on.
Oh, I'm sorry. It's 11:10, and I always try to be respectful of everyone's time. Can we go a little bit longer?
Yeah, Jim, you have another 5-10 minutes?
Oh, absolutely.
We try to keep this to an hour just to be respectful of everybody's time. But yeah, if you can do another 10 minutes, we'd love to. And sorry.
I'm having fun.
Nice. Wonderful. And just a note to everybody out there, we've had about 50 questions on this, is there, you can definitely rewatch this in its entirety when it's over. Absolutely. So if you're joining late, this exact link, you can just copy and paste it after it's over, and the whole video will be there. So do not worry about that. Jim, we've had, I keep calling you Jim. I'm sorry, JL. It's 8 years of friendship calling you one thing. And JL, we've had a bunch of questions about REITs and real estate investing itself. So not home ownership like we talked about before, right, but actual real estate investing, which I think there is.
And there was an expansion to that too, which asked whether or not you have any other holdings other than VBTLX and VTSAX to include REITs or precious metals and other things too. I saw those questions go by. So
nice. Yeah, no, thank you for clarifying, Jen. That's great. So yeah, I mean, talk to us about REITs and real estate investing as one thing, and then we'll go into any additional precious metals, things like that, if you even entertain such things.
Okay, so let me start with Jen's question, and we'll sort of work backwards. The only thing I have in our portfolio is VTSAX, and again, about 75%. VBTLX is about 25%. We do have this beach cottage that sometimes is a VRBO, and sometimes, like now, we're using it ourselves. And I have some cash, and that's it. That's all we have. The beauty of that, by the way, when I die, is it's going to be very simple for my heirs to deal with, and that is part of the beauty of the simple path. Is it's simple on lots of different fronts. I used to own REITs, Brad, and in fact, I have a post. I think it's in the stock series called "Stepping Away from REITs," and again, anybody who's interested can use the search function to find it. Basically, the reason I held REITs, and REIT stands for Real Estate Investment Trust, so it allows you to own real estate without any of the hassles of managing it day to day. It's like owning a mutual fund. The reason I owned it was as an inflation hedge, but the more I looked into it, the more I concluded that it wasn't that good an inflation hedge. Certainly was no better than common stocks, no better an inflation hedge than VTSAX. And so because the reason I owned it didn't exist anymore for me, I stepped away from it. Real estate more generally as an investment, and now we're talking about real estate that somebody might actually own and buy, and buying a house to rent out, or an apartment, or a 2-flat, and then managing it themselves, or finding a manager. That's a wonderful way to make money. I used to do it decades ago. I don't anymore because it's too much like work. And I think that's the key thing when you're looking at real estate in comparison to something like VTSAX. VTSAX takes none of your time at all.
Right.
Real estate is a hybrid. It's an investment and it's a part-time job, or sometimes for some people it's a full-time job. And so the question you have to ask yourself, is that how you want to be spending your time as well as investing your money? If the answer to that is yes, then real estate can be a great investment. You need to take the time to really learn how to do it well, and there are lots of great sources for that. But real estate, absolutely done well, can make you wealthy if you're willing to put in the time in addition to the money. One point in my life, I was willing to do that. And now I'm not.
Yeah. I like the simple approach. Yeah. I think Brad and I are both like simple, right?
Yeah, I definitely like simple. And, it's funny. I pulled up one of my favorite Warren Buffett quotes, actually, since someone asked about precious metals. So he talks about gold and the lack of utility. And he says, you could take all the gold that's ever been mined and it would fill a cube 67 feet in each direction. For what it's worth at current gold prices, now this was years ago, you could buy not some, but all of the farmland in the United States. Plus, you could buy 10 ExxonMobils, plus have $1 trillion of walking around money. Or you could have a big cube of metal. Which would you take? Which is going to produce more value?
I'm going to throw a monkey wrench. I don't own precious metals, but I've had some people tell me that I should actually consider using metals that are buying small shares of metals that are industrial, like copper. And I think it's sort of an interesting thought, but I have not explored that. I'm a simple person with more asset classes in my portfolio than either of you, but still simple.
No, that's fair. And the simple is fair. And I love that Buffett quote because it's it's based around utility. Awesome. And sorry, JL, I talked over you.
No, that's okay. So Jen, going to investing in things like copper. I mean, if the idea behind that, of course, is that industries that use copper are on the upswing, and therefore the demand for copper is going to be on the upswing. And I would say, why not just buy the stocks of those industries? Or better yet, why not just buy the total stock market and know that you own them by default?
Yes.
I love the Buffett quote, Brad. I have heard that before. I haven't heard it in a while, and I love it. The problem with gold in my mind is that you're buying it hoping and expecting that somebody else will be willing to pay more for it at some future date. and so you're just sitting on it. It has no productivity, which of course is what Buffett was talking about. You're not growing anything on it like farmland. You're not owning a business like when you own stocks that is doing something productive, that's generating cash and what have you. And I've just never particularly seen the value to it. There is some research that indicates it's not actually a very good inflation hedge, which is one of the reasons that people like to own it. Some people like to own it as an end of civilization strategy that, when all the rest of the economy collapses, but I think you're better if that happens. You're better off owning guns and ammunition and
MREs maybe.
Yeah, MREs, and then you can take the gold away from the people who own the gold.
Oh, you guys are so funny. I love it. But yeah, I don't see the utilization of gold. It's not one of the things that attracts me. And
I'm sorry, Jen. Go
no,
ahead.
Please.
No, I interrupted you.
No, please. You're our guest.
I was just going to say I was reading an article by a guy who's a big advocate for gold recently, and this particular person's reasoning is that they're very concerned about the value of the dollar. And we talked about, the national debt that seems to be running out of control. And of course, that will at some point presumably have an impact on the value of the dollar, and gold is an alternative for that. But the implication there is that you're holding a lot of cash, you're holding a lot of dollars. And I agree that holding a lot of cash is a risky thing to do for those reasons. But instead of moving that cash into gold, I prefer to move it into my bond fund or my stock fund, which have the same effect of getting it out of cash, but it's now in something that's actively producing value in a way that gold simply can't do.
Yeah. So there was a fun question. I wanted, Scott Harris asked, did you bring your motorcycle with you to the shores of Lake Michigan?
Yeah, that might be a fun question for Scott, but it's kind of a sad question for me.
Oh, no, I'm sorry.
No, that's quite all right. The answer to the question is no, I did not bring the motorcycle. And the reason I didn't bring it is the time had come for me to step away from motorcycles. Motorcycling is inherently a dangerous sport, and it requires, I think, certain basic skills like reaction time and coordination, and those things diminish as you get older, and I notice them diminishing in me. And so when I was faced with the idea of having to move the thing cross country, I thought, really, the time has come to step away from it. And every now and again, I'm tempted to get another one. I did love it at the time. It was a wonderful, which is why it's kind of a sad question. But no, I didn't bring it with me, and I no longer have one.
Maybe it's time for a bicycle a la Pete Adney instead.
Well, I actually used to be a very avid bicyclist before I moved into motorcycles. So, yeah.
Well, I'm sorry, but I hope you're still enjoying the house and the lake.
Oh yeah, nothing to be sorry about. It's just, yeah.
Yeah.
Then we have a bunch of comments. It's amazing how many people have been inspired by you. We probably had a couple hundred of these comments, but David just said, JL Collins, you've inspired me since I got interested in the FI movement. Hi from Yorkshire, England. And we have Baiba. Greetings from
David.
Greetings from Latvia. Me and my husband are on our way to FI, and your book was the first one we read on the subject. It is wonderful.
Yes. So, and I wanted to let you know, Dan Phillips at the very beginning of our stream asked whether or not you wanted to be called Jim JL. And of course, we know that it's JL now. Yeah, and then, but he said the greatest of all time, GOAT.
The goat.
The goat. So definitely it. And Tommy wants to make sure that you can you tell his wife this? JL, can you tell my wife it's okay for me to invest in a low-cost index boat? And then, of course, we have some, comedians, and I think John suggested naming
so
it
before we go on,
TSAX.
Tommy, you're on your own.
Sorry, Tommy. Tried for you, man. Yeah. I tried.
Your odds, Tommy. That was the... Tommy had our poker comment before.
Yeah. Oh,
So
JL,
JL, what does the next handful of months look like for you? Anything noteworthy going on?
Well, COVID makes that kind of difficult. We, as I mentioned early in our conversation here, we're fundamentally nomadic. Our plan before COVID was to return to the beach house here and spend the summer. Last year, we were in Europe for the summer between Chautauquas, and we had the beach house rented out. But we decided we wanted to come and enjoy it ourselves this summer. So, and COVID certainly has made that the right decision, although we didn't see that coming. And then, frankly, our plan at the end of the summer was to consider selling it because it really doesn't fit in with our nomadic lifestyle. It's up here on the shores of Lake Michigan, and ordinarily it's not part of our regular traveling route, if you will. So it's a little inconvenient to get here. But so come fall, we'll decide whether or not we're going to keep it, depending on how the summer goes and how we feel about it at the end of that. And then the plan come fall was to go back out into our nomadic lifestyle again. But that depends on what's going on with the virus, and seems to be the virus is resurging pretty strongly these days.
Yeah.
And who knows what it'll be like come October, November, which is when we intended to go back on the road. So it's possible we'll be wintering here. We just don't quite know. But the ideal plan is to spend the summer, fall here, and then go back on the road.
Well, Kevin just said, better safe than sorry. You are a national treasure. So
yes.
But I think to your point, it's something that all of us do in life, right? Like we take in new information and we make the best decisions we can at the time, right? It's unknowable what life is going to look like in October, November. You have no idea, but you make the best decision. You keep an open mind and you go with it, right? That's how decision making works.
And Brad, that's kind of a summary of the whole FI retirement thing is you have to be flexible because you don't know. None of us know for sure what life is going to throw at us. And the only security is flexibility. And so there you go.
Agreed. And I think, this is something I was going to ask you about earlier, and I'm not going to here, but, just talking about flexibility of making mistakes, of, you and we've talked personally offline numerous times about I've made catastrophic errors with financing and real estate, and you obviously didn't hit on VTSAX 40 years ago, right? Like we all come where we are.
If only.
Right. I mean, but seriously. And I mean, it's important to know out there, everybody, like we're trying to get better. We're trying to learn constantly, no matter how young or old you are, we're constantly trying to learn. And you take in new information, and you can't beat yourself up about mistakes you've made in the past or sunk costs. Like they are what they are. But as Jim and people in the FI community like to say, with a 50% savings rate, it's pretty hard to go wrong with that. And if you have that as the fundamental base of you save money, you obviously by definition spend less than you earn, things are going to work out okay for you, right? And we can have conversations at the margins of, should I have 72% in VTSAX and 28% in bonds? Like we can talk about that at the margin, but really being flexible, being open-minded, and having that savings rate, that's the kind of stuff that really truly matters, in my opinion.
Yep.
Brad, I absolutely agree with you. And as we said early in the conversation, there are three keys: avoid debt, save a large amount of your income, and invest it. We mentioned earlier, we were talking about dividend investing, and you were buckling up, and as you know, I'm not a fan of it. But choosing whether to be a dividend investor or investing in a broad-based index fund is a much less significant decision than your savings rate. So if you have the appropriate savings rate, I think, and you choose to be a dividend investor, your road's going to be a little slower and harder, in my opinion, but it's going to get you there. It's not like you're choosing between a good thing and a bad thing. And in fact, I'm fond of well, I don't know if I'm fond of it, but I do tell people that I actually achieved financial independence picking stocks and picking actively managed funds because I hadn't discovered indexing. Now, to be clear, had I discovered indexing sooner, I would have hit FI sooner, and the path would have been a lot easier and smoother. But it's still picking individual stocks got me there. It just wasn't optimal. So
yeah,
there you go.
And I do love the fact that there's still time for recovery. And I have to say, flexibility, that point hits home. Flexibility is the thing that will help us be safe, secure, and even build a path to our dreams, right? And our dream life.
Here. I think.
Yeah. Wow. And I just want to thank you on behalf of the FI community for your guided meditation.
Yeah.
And that video clip of you with the FU money, I also shared that around too, probably way too much. But it's wonderful to see you and to meet you virtually. Thank you.
Well, likewise, Jen. It's wonderful to meet you virtually, and Brad, it's always fun to hang out with you.
Right back at you, buddy.
And I'm glad that some other people showed up.
Oh my gosh, so many people.
Been incredible. Truly, thank you all for being here. Thank you for the comments, the questions, everything. I mean, this has been remarkable, and this will be available again with this same link. You can just copy and paste it if you came in late, or if you just want to watch Jim's incredible advice again. So yeah, thank you for being here, and Jen, as always, thank you. And
thank you,
JL. Really sincerely appreciate the time. This is remarkable. Absolutely. We'd love to do it again. I'm sure we could field another 200 questions if we wanted. So let's do it again.
And we're going to do it again.
Yeah, I was going to say, I'm happy to do it anytime you're silly enough to invite me.
Oh, that'll be every week. Hello. But I will be following up with my dream team panel discussion at some point for investing. So pardon me if I hit you up. Thank you for your email address. And I will use that with judicious professionalism. Thank you. And then that. I just want to let the viewers know, thank you so much for tuning in. And next week, we've got a couple of really great events coming up. Actually, Wednesday, we have a really great event. It is with Grumpus Maximus. It is his happy hour and launch party for his new book, The Golden Albatross. Anyone who has a pension should tune in for this one, because we're going to walk through some of the considerations you might want to look at in order to evaluate whether or not you should stay or should you go. And yes, I am playing the Clash song in my head. Should I stay or should I go? And then we're taking a break for the 4th of July, and then we'll be picking it back up the following week. So don't miss out, because the following week, that Saturday, July 11th, will be, Brad, do you want to announce it?
Yeah, none other than Brandon, the Mad Scientist. So yeah, we have a dream team coming up here in 2 weeks. So thank you all.
Yeah. So please stay tuned.
Yep. And JL, just real quick, for anybody who's looking to find you, obviously the Simple Path to Wealth is available on Amazon and wherever books are found. And would you recommend jlcollinsnh.com is clearly where people can find the stock series? Anything else I might have missed?
No, that's it. I mean, when they go to jlcollinsnh.com, that's the blog, and they can also connect to me on Facebook and Twitter from there if they're so inclined. But I have to put in a plug for our mutual fund, Brandon. I remember when I first discovered the Mad Scientist, and he and I are now friends and have been for a number of years. But that was one of the few blogs. I've been knocking around this financial stuff for decades. And when I started reading The Mad Scientist, it was one of the few things that I'd found out there which really made me sit back and say, wow, I hadn't thought about that. Or wow, I hadn't thought about that in that way. So an incredible guy, and I'm personally looking forward to it.
Nice.
Yes, I'm going to have to tamp down my enthusiasm for that one as well. But and Brad, I hope you don't mind, but that's the one day that I'm going to wear my Mad Scientist shirt instead of my ChooseFI shirt. Okay. So
by the way, when you interview him, tell him he still owes me a Mad Scientist T-shirt.
Oh, come on.
You bet. I will. I'll hold the feet to the fire. Thank you so much. Nice. Thank you, everyone, for tuning in. Have a great weekend.
Thanks, everyone. Bye-bye.